Hi, this is Ken Boyd with the Accounting Accidentally blog site and accountinged.com, and I wanted to talk about part of a course I'm doing on private equity, and the subject here is EBITDA versus cash flow, basic valuation measurements. And I'd like you to think about, well, what has value? If you were buying a business or if you were selling your business, what has value? What creates value in a business? And on a basic level, it's earnings and cash flow. Now, I'm going to set aside for right now the fact that you might have a unique piece of intellectual property or something unusual in that regard. But on a basic level, earnings and cash flow, and I like to use the Play-Doh analogy, where just like a Play-Doh machine, what you put into the Play-Doh machine is capital, cash, and other assets. You turn the crank of the Play-Doh machine, that is making a product or service, and what comes out the other end is earnings and cash flow. And we would love it if those earnings were consistent earnings. Now, there are certainly growth situations with startups where you're willing to take losses or some gains and some losses for a period of time because of the potential growth of a product or service. But consistency is really, really valuable. The fact that you can go out and crank the Play-Doh machine and spit out earnings and cash flow every year. But you have to be careful that you don't have a buildup in receivables. So as cash comes in, cash coming in has to keep up with your growth in sales and your growth in profits, or else you'll get a bigger and bigger receivable balance. So that's a special caveat when it comes to earnings and cash flow. So let's switch and talk about two measurements, EBITDA versus cash flow. EBITDA refers to earnings before interest, taxes, and depreciation expenses. Now, there is a weakness or a distortion that EBITDA causes, which is the impact of capital expenditures. Because if you're replacing, upgrading, and adding assets, fixed assets, you're going to incur more depreciation expense, and you're going to sort of eat up, if you will, earnings because you'll be spending more earnings on depreciation expense. But that's not necessarily a bad thing, because by adding, replacing assets, you're more productive. If you buy a new sewing machine, you'll produce more pants than the old sewing machine at a lower expense, lower maintenance expense. And you're also opening up more capacity down the road to grow. So buying more fixed assets and incurring more depreciation is not necessarily bad. Another thing to keep in mind is that from a budgeting and forecasting standpoint, every budget includes a budget for capital expenditures, or CapEx as it's called. And any responsible manager is going to plan for that, because if you don't, you're not really creating a realistic plan for your business. So cash is king, ultimately. And those are two examples of valuation metrics, EBITDA versus cash flow. Remember that you can find me on the Accounting Accidentally website. I've got over 80 blog posts, links to all my YouTube videos here and other things, and also the Accounting Ed site, an online trading academy with hundreds of videos, dozens of hours of content if you have an accounting background. Thanks so much for watching. We'll see you next time.